Hi, in this video, I'm going to talk about gift basis. So basically have a situation when the fair market value greater than the donor basis. So here the fair market value is the time the gifting, the market value of the property, that's the fair market value at the gifting. If it's greater than donor basis, those two situations, sales at a gain and later sales at a loss. I'm going to explain what does this mean. So first, we're going to see sales at a gain situation. So when fair market value greater than donor's basis, and later donee sell the property at a gain. So the donor's basis and holding period are used to calculate the gain. So here we just explain if the fair market is equal to or greater than the donor's basis, the donor's basis is used as the donor's basis for all the purpose. Let's see an example. Say, assume Mike bought 10 shares of the Amazon stock for $1,925 per share on April 25th, 2019. He gifted the stock to his daughter Lisa on April 20, 2021, when the fair market value was $2,400 per share. So the donors adjusted basis you can see is the purchase price of Mike is $1,925. So the fair market value date of the gift is the $2,400. So those are the dates. So sales at a gain. Sales at a gain means the sales price is greater than donor's basis. Then you can see that if Lisa sold the Amazon stock on March 15, 2021 for $3,350 per share, you can see the sales price is greater than the donor price because the fair market value is greater than the fair market value as well. So we use the donor adjusted basis to calculate the gain. So you would get a gain per share is this much. Then so once you have this again, you would consider, think what's this again, a long term or short term. So in this time, we use the donor's holding period is from this one to the sales price. So it's more than a year. So it's a long term capital gain. So which means proceed of Lisa to sell Amazon stock is 33,500. So, however, there's a long-term gain in it. This much long-term gain. So she has to pay tax on the long-term gain. So if her long-term capital gain rate is 15%, so she would incur a tax liability is 2,138. So this is when the sales price greater than donor basis. This is sales at a gain. So what happened if Lisa sells the stock's price less than the donor price? Let's see this example again. We said fair market value sell at a loss. Donors basis and holding period are used. So this is the same situation. This is exactly the same situation. We just change the side if sales at a loss. So on May 15 is at a loss 1800. In this situation, we use the donors adjusted basis to calculate the loss. So the loss is $125 per share. So use donors holding period is for this loss. This from the donor's holding period to the sales price that will give you a multi-year holding period is long-term capital loss. So the proceed Lisa received is $18,000. You can see the sales price is much for 10 shares. So the total long-term capital loss would be 1,250. You can say for 10 shares. So this loss. So Lisa would get proceed is $18,000. Then she has a long-term capital loss. She can use this long-term capital loss to offset any capital gains.